But welcome back to all of you. Um, I now have the honour of welcoming Sir Hector Sands, Chair of the Money and Pension Service, to give a keynote speech. Now, I was honoured to do my apprenticeship with Sir Hector at the FSA and to witness at first hand his leadership of the Financial Services Authorities that navigated the 2008-9 financial crisis. As if dealing with that crisis wasn't enough, he was also instrumental in setting up the Money Advice Service, which subsequently became MAPS, of which he is now the chair. Many of you will also know about his subsequent role chairing Step Change, the debt charity. Now, I know he won't mind me saying that he went down with COVID over the weekend, but he's insisted on going ahead with his address today, which is a sign of his commitment to these issues and for which we are very appreciative. Now, following Sir Hector's address, Eric Leenders of UK Finance and Theodora Michael of Responsible Finance will join a discussion with Michael Royce and James Fernie, both from MAPS, chaired by our Vice Chair, Sean Williams. So if I may, Hector, ask you to give your keynote address to the meeting. Thank you.
Thank you, Chris, and thank you for your kind comments about our previous association. And of course, thank you to the Financial Inclusion Commission for the opportunity to contribute to this extremely important topic. As Chris has indicated, I'm afraid I'm in a little bit of a COVID brain fog at the moment, and a bit of a challenge this, but I've got a clearly written text in front of me in large print, so hopefully if I go slowly, I will be able to get through it without too much difficulty, but my apologies if I need to take a break at any point, and if I'm not maybe quite as coherent and lucid as I normally at least strive to be. But anyway, as you're probably broadly aware, just over 2 years ago, or I hope you're aware, the Money and Pension Service, MAPS, made its first major strategic intervention into helping people manage their money. In January 2020, we launched the UK's first ever national financial well-being strategy. Now, our UK strategy was developed with the explicit support of government, and it drew on a combination of 12 months of listening to over 1,000 stakeholders. And of course, we drew on the experience of our 3 predecessor organizations that had been put together to create MAPS a year earlier. The strategy sets a 10-year framework with ambitious national goals, but focused on 5 agendas to drive change at scale and achieve our vision, which hopefully all of you know by now, is that everyone makes the most of their money and pensions. Whilst, of course, the strategy could never have accounted for the pandemic and its profound impact on the financial lives of millions, COVID arguably makes it even more important. The physical impact of the pandemic on the nation's health and the connected economic disruption, I think, is clear to us all. But it shouldn't be forgotten, as has already been alluded to, that mental health problems have also increased significantly during this period. For many who are already struggling, COVID-19 has clearly made things financially worse. Some households already in precarious financial positions before the current crisis are now undoubtedly struggling to keep afloat. Yet, of course, the pandemic has not impacted everyone in exactly the same way. While some have been unable to work and lost some or all of their income, others continued to work on a full salary without the cost of commuting or socializing. It does therefore feel an important opportunity now, 2 years after the strategy was launched, to take the opportunity to take stock of where we are. So over the next 20 minutes, I aim to provide you with a progress report on our UK strategy and what it means for your organisations, and outline what we need to focus on to drive further change. Firstly, just a brief introduction to MAPS for those of you that may still be unfamiliar with our work. As I mentioned, we were set up by the Financial Guidance and Claims Act in 2018, and we have a statutory mandate to help members of the public make informed financial decisions by supporting the provision of financial information, guidance, and advice to those most in need, i.e. our focus is absolutely on the vulnerable community, which of course puts us right in the middle of the financial inclusion agenda. We summarize our mandate with a straightforward vision statement: everyone making the most of their money and pensions. This is because when people feel more in control of their finances, individuals and communities are healthier, businesses are more prosperous, and of course, the economy benefits. This vision may appear a simple one, but better well-being can only be achieved through several related components, notably numerical skills for appropriate financial literacy, learned capability and confidence in managing money, as well as access to the appropriate tools, products, and services, financial inclusion. Financial well-being, therefore, goes beyond helping people make better financial decisions. It's significant because it's central to personal well-being and thus to living a contented life. Indeed, according to our new financial well-being survey, which we released last month, people who have high financial well-being and feel secure and in control, and that is the key element I'd like to stress about well-being. It's as much about feelings and behavior as it is about capabilities and amount of money. People who feel in control are amongst the most content in society. In fact, people with high financial well-being are more satisfied with their lives than those in households with the higher incomes above 50,000. We also, however, recognize, again, as been mentioned earlier, the limits of financial well-being. Whilst managing your money can make you feel more in control, money management, of course, is not the full answer to those who simply do not have enough. So notwithstanding those challenges of real financial poverty, the importance of building financial well-being is clear. Excuse me. Which is why we are working alongside colleagues in government, regulators, and the financial services sector to ensure that financial well-being is part of the desired social policy outcomes in building back better from the pandemic. In particular, we spent the past 2 years working collaboratively across the UK so customers can access improved high-quality money and pensions guidance and debt advice throughout their lives. The primary example of this I'd like to cite is in pension guidance, where we've worked to ensure our offering is much better defined and expanded. Money Helper, our new consumer brand, provides one point of contact for impartial and free guidance on money and pensions. It's complemented by our pension guidance transformation program with an emphasis on the right guidance at the right time. Our aim is to create a seamless, holistic customer journey with a choice of channel options. This includes a new guidance appointment for those at risk of scams and processes to support the subsequent referral to PensionWise from providers. From next year, schemes and providers will also begin to be legally compelled to connect to the pension dashboard ecosystem. Dashboards will become available to customers to use when enough schemes have connected, and this will be a key step forward, encouraging people to plan for their future. What I'd now like to do is to discuss two areas of focus which will drive the financial well-being over the next 2 years. And they both specifically reflect our mandate to support vulnerable people, those in or near financial distress. We know that debt advice can and does change lives. Evidence shows that debt advice can help resolve people's money issues, increase their confidence, improve their well-being, and set them on a road towards greater financial resilience. As the largest single funder of debt advice provision in England, MAPS already had a significant focus on the support people need, but the events of the past 2 years have only made that focus more acute. We've been working with Treasury on a shared vision of how the debt advice landscape could change to enable more people to access free expert debt advice using different channels, including learning lessons from remotely provided advice during the pandemic. You've already heard from John Glenn about Breathing Space in England, a landmark policy giving people in problem debt the right to legal protections from their creditors. It is a part of that vision for better debt advice. Alongside the 40-odd thousand applicants for Breathing Space, MAPS has invested another 2.4 million in a pilot, which is expected to support around 6,000 to 7,000 people living with severe mental health problems who apply for breathing space. In direct response to the pandemic, we've also acted quickly to secure extra funding to ensure capacity is available in the overall debt advice market when the predicted demand emerges. This demand increase is emerging, but is not yet fully with us. Yesterday, MAPS announced that it has a maximum annual funding envelope of 76 million for the delivery of debt advice services in England, subject to the usual annual budget setting by government. This represents a significant increase from pre-pandemic funding levels, which totaled 43 million in 2019-20. However, as I'm sure many of you will be aware, these changes we're proposing have not been without challenge from some people within the debt advice sector. However, I believe our core objective to make free of charge debt advice available to more people who need it, specifically ensuring the needs of people in vulnerable circumstances are met, is an objective which is shared by everybody. Therefore, it's important we take into account the feedback we've received, and we have decided to pause some parts of our plans. We had previously announced that we would not be proceeding with the current procurement of the regional services, which contain the face-to-face elements. Instead, grant funding levels for these services will be maintained at similar levels in 2022-23 as currently. Our intention is to fund regional services at 30 million per annum until we conclude our work with the sector to identify the best approach and level of funding required to deliver those local services. We are very clear that in designing these services to increase capacity, we will work to support everyone, particularly the vulnerable. Our long-term goal remains ensuring that all parts of society have access to and receive high-quality debt advice when they need it. I'm confident our revised programme will represent a big step in this direction. The other area of significant development I wish to highlight today has been in financial education for children and young people, which a number of people have already observed in the conference today is extremely important. Education about money makes a difference, and it needs to start early. Evidence suggests that children start to learn vital money skills and habits between the ages of 3 and 7. MAPS has already invested significantly in financial education projects to see what works for children and young people. We now have a substantial evidence base from pilots, which only required seed investment to work at scale. Indeed, NatWest has recently offered to scale up our Talk, Learn, Do workshops for 3 to 11-year-olds and their parents. One of the many examples where we're working alongside the sector to push a broader well-being agenda to those who need it most. However, there are still considerable strategic issues. As an organisation, sector and a nation, we need to tackle in the next 8 years so that everyone can make the most of their money and pensions. In addition to building on our work to expand debt advice, helping those in financial distress, I'd like to highlight 5 areas where we need more action and more engagement. Tackling these 5 points would be a major step forward in achieving the long-term goal of raising the financial well-being of the nation. Firstly, I believe we need to build short-term financial resilience. A savings buffer has traditionally been recognised as a first step to achieving this goal. The past 2 years has seen a gradual depletion in savings for many in vulnerable groups, leaving them more at risk to financial shocks. Increasing energy bills and a prolonged pandemic recession will put a further squeeze on household budgets. It remains hard to entice non-savers to start saving regularly to build a buffer. So MAPS is working with industry and employers to test different defaults and incentives. Providers are responding in different ways to the current environment. Some credit unions are taking forward a prize saver scheme, trying to entice new lower income savers in that way. Offering payroll deducted cash savings schemes through the workplace, tapping into default behavioral biases with pay being taken at source, is another route we've been exploring. The testing of different nudges on opt-in, payroll savings schemes has shown some limited success in increasing take-up. However, we are much more hopeful about opt-out models. Secondly, I spoke earlier about financial education and some of the progress we have made. I welcome this progress, but real success for financial education in the UK will ultimately require greater engagement from educational institutions. There is much work left to do in schools in partnership with the Department of Education and devolved governments. In 2019, 5.3 million children still weren't getting a meaningful financial education in the UK. Only 34% of children recall learning about how to manage money at school or college. The disruption to education caused by COVID has probably made this situation worse. Schools, however, are only part of this picture. Success in financial education requires effort from us all, teachers, parents, and carers. Evidence shows that parents and carers are the main source of learning for children and young people. Most children and young people say they would turn to their parents if they needed advice about money. This is why we are currently focused on scaling up proven toolkits to parents and carers like our Talk, Learn, Do program, so that every child has the best start to their financial education, regardless of which school they attend or which country they reside in. Supporting children and young people in vulnerable communities with financial education should be seen, in my view, as a central part of levelling up the UK. If we target supporting practitioners with consistent and available information on financial education, then the child in social services could theoretically have the same access to resources and knowledge as the child at a grammar school. Turning now to the core challenges, we need to narrow the information and capability gap between firms and consumers. In my view, this will require us to shift the guidance advice boundary, a topic much discussed, of course. The financial service sector is working to develop more focused guidance, delivered to consumers where they reside in accessible forms. However, firms aren't currently incentivized to undertake more prescriptive guidance. Indeed, the risk of getting it wrong can outweigh the reward of delivery. We need to develop better guidance support for consumers to improve their capability. So what is the solution? Well, I think the proposed FCA consumer duty represents a good opportunity. MAPS welcomes the duty as a way which can help the financial services community reappraise the consumer protection framework and really take on board the lessons of the last few decades. Under these proposals, firms will review how they communicate with and support their customers to develop their confidence and ability to make financial decisions. We're particularly pleased that the latest version of the FCA consultation proposals enhancing consumers' confidence in both the financial services and themselves. Now, the overall focus on proving consumer capability is admirable, but I would argue we still need to move the boundary to make guidance more personalized, directive, and delivered where possible by a non-commercial organization. This might also provide a more reliable mechanism for judging whether the individual was equipped and informed to make good decisions. Finally, may I turn to products and services? Again, a topic which has already been touched on by the Minister. Even competent and knowledgeable consumers need appropriate access to products and services to execute their needs. We need more work to develop products which offer alternatives to high-cost credit, especially at a time when consumers are struggling and a number of providers have left the market. We welcome the work of Fair for All Finance, referred to by John Glenn, to develop no-interest loans and to engage with mainstream financial services for wider availability of low-interest loans, as well as their core work with the community finance sector. We are working with them to raise awareness of community finance alternatives. Finally, it's important that we recognise other factors that many disadvantaged people in relation to their financial well-being are suffering from, notably digital exclusion. The most recent Lloyds Consumer Digital Index report indicates that despite significant increases as a result of the pandemic, an estimated 5% of the population is still offline. A further 29% nearly a third, had very low digital engagement. Using digital channels and other technologies to reach and impact more people is a key part of future access to appropriate financial tools, products, and services. But in my opinion, we should not forget the significant role of face-to-face human interaction, particularly for vulnerable people, when we're looking to support their tangible well-being. As discussed earlier, I think fintech is part of the solution, but it is not the solution. Ultimately, financial products should be simple, accessible, and have customer well-being outcomes at their core. Simple and accessibly designed products can work just as well online, on the phone, or in the branch, or in a face-to-face environment. So before I conclude, I'd just like to leave you with one final thought. We know that when people feel more in control of their finances, individuals and communities are healthier, businesses are more prosperous, and the economy benefits. As we build back from the pandemic, we need to work across industry and government and the third sector to continue to promote financial inclusivity for all. But I think critically, and I don't believe we've yet fully achieved this, we need all of us, we need all those entities I just referred to put building financial well-being at the forefront of their institutional agenda, and where appropriate, they need to embed it into their cultures. And I think whilst we have made a lot of progress in that space, I don't think that we could really say that we have yet achieved placing financial well-being and financial inclusion at the top line of the national debate. I very much hope that this conference, Chris, is a step towards achieving that goal, which is one I'm certainly personally extremely passionate about. And insofar as I can, I'll do my best to participate in your panel, but we'll see how we go. I might have lost the use of my vocal cords, I think, at this point. Thanks very much.
Well, thank you, Hector. That was an extremely important address with a lot of new information in there, as well as some which others will be aware of. But that call to action at the end is something which I think is very important, and people, I think, will rally behind in terms of putting both financial well-being and financial inclusion at the forefront of the agendas. And we are particularly appreciative of you doing it when you're feeling unwell, and if you're able to join the panel discussion to the extent that you can, that would be great. So I'm now going to hand over to our Vice Chair, Sian Williams, who's going to introduce the other speakers for that session and host the comments that are coming from, which are already coming up on the chat. So over to you, Sian.
Thank you, Chris, and thank you, Sir Hector, and also just thank you to everyone who's with us today. It's such an important topic, and the discussion so far has already been brilliant. So please keep your questions coming, and we'll try and make sure that we make the most of the remaining time. And then if you've got any questions that we can't get to, we will ask our panelists and others to help us send out responses. So please don't think that it's not worth putting a question just in case we don't get to it. We'll kind of try and come back to you. So we've heard from Sir Hector, and we're going to hear now from two other people who I think have really important views, given many of the questions that are coming through, but who have a lot to kind of say about financial inclusion and the provision of services and products. So first of all, we'll hear from Eric Linders, who is Managing Director of UK Finance. And then we'll hear from Theodora Hadjimichael, who is CEO of Responsible Finance. Now, some of you have already flagged rightly that it isn't just about credit, and we're not suggesting that it is. And you'll hear from me at the end that we've got other sessions coming on other topics. So please don't think that our choice of speakers today is suggesting that we think it's all about credit, because it absolutely isn't. But we absolutely know, don't we, that not having access to affordable products and services from financial services providers drives financial exclusion as much as anything else. And so it's a really important part of the topic. So Eric, I'm going to call on you first. We've asked you to kind of start with an opening 5 minutes of reflections and thoughts about what you've learned really from the pandemic and how the industry can do things differently. So Eric, love to hear from you.
Thanks, Sian, and thank you very much for inviting me to speak. I'm conscious that we're a little tight for time, so I'll try to keep it brief so that we can address some of the questions that have been coming through. I guess the first thing I should say is that the pandemic has provided the financial services sector to demonstrate the importance of the support that it can give to its customer base or its customers. And in that context, I wouldn't want to necessarily evangelize or be too triumphalist, but several millions, 4 or 5 million customers helped with payment deferrals. About 27 million overdraft facilities were put in place for a period of time as well, when the real uncertainties of the pandemic were biting in 2020. I think the most important part from that is not so much the support that has been given, but actually the change that we have seen in discussing finance between a lender particularly and their banker. And that's come about because at the end of a payment deferral, the customer obviously needed to communicate what their plans were and what their circumstances were. And that has helped very much to break down a bit of a taboo or something of a perception wall, where consumers found it quite difficult to explain to their financial service provider that their circumstances had deteriorated or they needed further support, by and large, because I think there was a degree of fear that whatever service was provided might be withdrawn. So I think lesson number one would be financial services needs to take on board more than just the plain simple language that has been discussed and is in the chat bar this morning, but also needs the empathy and needs the understanding to put themselves in customers' shoes and to think about those circumstances from the demand and not just the supply perspective. I suppose the second point I would make, which is going a little off the carefully scripted brief I see on my other screen here, and that's when my new boss joined about 12, 15 months ago. He said to me, very big agenda on personal banking and lots of things going on across the market, mortgages, loans, etc. And I sort of said, well, actually, it comes down to one word, right? And that word is access. Now, we're talking about inclusion, which is a development and a build on access. But if one takes access in the context of access to banking services, it takes you through digital inclusion, it takes you through the access to cash agenda. And then if you think about budgeting, actually it is that element of support, which is credit, access to credit and access to finance. I see a number of credit unions have mentioned how they are keen to play a role in that space. So as we face into one of those slightly idiosyncratic economic situations where the macroeconomy is growing and is in relative good health relative to G7 countries, the household or real economy is deteriorating, and we know that through RPI. And so there is a consideration of access alongside an empathy for what support might be given. And that, I think, then takes me to my third point, which would be in and across all of that, the regulatory landscape is changing fast. And we are seeing increased focus on vulnerability. Guidance came out last year, and during 2022, a concept of a consumer duty to be introduced, which I think if the Financial Conduct Authority were on the panel, they would argue would go some way to supporting Hector's view of financial well-being. Whether it will or not, I think, is a moot point. And I think that one of the real concerns or risks is around financial inclusion, in the sense that firms that need to comply, obviously, with the regulation might become nervous that their approach to products and services steps over the line. and that actually they are safer not providing products and services to certain customers. That, of course, is an exclusion in itself. So we do need to be quite thoughtful, I think, about the way that the consumer duty and vulnerability is discharged. I have to say I'm more a fan of the vulnerability guidance than currently consumer duty. And it's interesting, I think Martin Kopak has raised the point about whether the Financial Conduct Authority should have regard for financial inclusion or similar. And we're actively considering that in the context of the consumer duty, because we are nervous that there might be consumers that are excluded from markets and specifically products and services, which we don't think would be helpful at all. So some thoughts there, Sian, hopefully provoke a little conversation and discussion. And I'll pass across to colleagues on the panel.
Thank you, Eric. And we know each other well enough to know that if no one else in the audience comes back with a challenge on that, then Martin and I certainly will. So thank you. That was a really, really helpful kind of set of reflections. Theodora, let me bring you in next. Responsible finance, the kind of title of the organisation is a really kind of important name to reflect on in itself. But just to hear about your reflections on what, where we are, what we need to do differently, and also if you can think about what the pandemic has taught your members and what they've learned about inclusion.
Definitely. Thank you, Sian, and thank you to the Commission for having me on today. It's such a timely event. And I just want to say also, to reflect on Hannah's point that she made earlier, we totally agree and think that we need to address the root causes of why people don't have spare cash. But I'm here to talk about ensuring they have good solutions when they do need to take on credit, because we believe everybody should have access and everyone should have choices when it comes to credit. And our members, community development finance institutions, or CDFIs, increased choice. When the minister's video was on earlier, he mentioned that people are at the heart of these discussions. So I wanted to just give you an example of a customer who has taken on affordable credit and it's changed her life. So one of a customer from a few years ago called Megan she became homeless after she went into rent arrears and lost her home. Shortly after that, she found out she was pregnant. And so she tried to take steps to change her life so she could provide a better life for her kid. And she was able to secure housing from the council, and she approached a CDFI for a small loan to help her make ends meet as she was rebuilding. The CDFI approved the loan, and they also gave her the option to open a savings account. In addition to credit, a lot of CDFIs provide wraparound services like access to budgeting advice, access to savings accounts, access to benefits checkers, all of which build consumer and customer resilience alongside the credit. So Megan opened a savings account and deposited a few pounds a week in addition to her loan repayments. She fully repaid her loan on time and decided to continue saving after her loan was repaid. And the amazing thing about this story is that Megan hasn't needed to take out credit again. She has been able to even cover expenses, emergency expenses like emergency home repairs she needed to do using the savings buffer she built. And I think that is such an incredible story about how access to affordable credit and the wraparound services that CDFIs provide has really transformed someone's life and put her on a pathway to having better life chances. And we know that that's not just a one-off. We have tens of thousands of stories like this each year. And we know that the CDFI model works really well. We're not commercial lenders. We don't have shareholders that we need to return a profit to. Our members are entirely focused on improving their customers' resilience and making their customers better off. We know that between 7 and 8 out of 10 of our customers fully repay their loan. And on top of that, the impact that we have is that CDFIs save their customers on average £250 per £500 loan compared to a high cost alternative. And that is such a good value for customers to be putting that money back into customers' pockets, especially in a climate like this coming out of COVID and looking at increased costs of living. So the evidence tells us that CDFIs and affordable lenders are making a really big difference, but they can be doing a lot more, as everyone has alluded to. I really welcomed the minister's comments earlier around his commitment and the government's commitment to growing affordable credit, because we know that the cost of living is hitting people really hard right now. And because of that, we know that the need for credit isn't going away. So 6 million people borrowed from high cost lenders last year. And I think that points to why affordable credit and the expansion of affordable credit is so important in times like these, because emergencies like a car breaking down and you can't get to work, or a washer breaking down and you can't wash your kids' clothes before school, those aren't going away, and people need good options right now. CDFIs are doing great work, and by scaling them up, that's something we can do right now to help more people. So I think just to conclude, I'm really, really happy to see that there's over 120 people on this call. And so I think if we can work together on a few things, I think that can make a meaningful difference in terms of scaling up options and choice for people who need credit. So there's 3 things I think we can do together. One is on the dormant assets. It's so imperative that those continue going to financial inclusion and to scaling up the affordable credit sector. Second, we are calling for banks and impact investors to invest into CDFI so that they can lend more and have more of an impact. And then finally, raising the profile of these choices so that and signposting to CDFI so that when people do need emergency credit, they have really good options to go to. So thank you again for having me, and I'm really looking forward to the discussion in the next 20 minutes.
Thank you so much. Very, very kind of helpful to hear your perspective, and I love your 3 kind of solutions and suggestions. So what I'm thinking of, the roadmap. As the Financial Inclusion Commission, one thing that we have always believed really strongly is that as a nation we need a roadmap, because if we don't know what financial inclusion looks like and we haven't set out a roadmap of how to get there, how on earth do people collaborate and work well together in order to make it happen? And I want to pick up on a point, first of all, which I think has come through really strongly, which is around connectivity between service providers. And so, so Hector's talked about we need to be able to have a really good network across the country of money guides, and people need to understand what they can do about managing their money well and what's available in terms of advice and guidance. He's also talked about the boundary line around what is advice, what is guidance, around regulation of person A supporting person B with knowledge and information around good money management and products and services. It's a constant refrain that we've heard for, more than 2 decades, that people don't know about credit unions. We know that the challenges that institutions like social landlords had around referring to credit unions needed actual explicit guidance from the FCA to say that that was allowed, because it's not a credit broker. So this connectivity piece, I think, is a theme that's coming through very strongly. And of course, through the pandemic, we had many, many different solutions to people needing to be able to get support. We had mutual aid groups, we had WhatsApp groups, we had all kinds of different ways of getting people to hear about support. So thinking about the world that we're in now, in 2022, emerging from the pandemic, and the way that society is talking differently with each other, how can we tackle that issue around good signposting, around awareness of products and services, around interconnectivity, so that if I'm that person who can't get affordable credit from my bank, but could possibly go to a responsible lender, a credit union or a CDFI, or maybe it's not credit that's the answer. Maybe I need a grant or support from my local authority in a different way. How do we build that connectivity? I'm going to ask Eric first, because I think that the mainstream financial services sector, I think is probably got the hardest boundaries around this for many different reasons. And I'd really like to hear from you, Eric, on what you think about that.
Sure. So I think to my first point, actually, as financial services sector, we need to be more empathetic and we need to have a better voice, which in itself engenders a confidence in having those conversations between lender and borrower. Second point you've identified is the Consumer Credit Act. It was a very important piece of consumer protection legislation in the 70s. It now feels as though it has run its course. And whilst I think the protections should be kept, it certainly needs to be adapted at the very least to a very different operating environment, a digital environment where there are far more lenders, etc. Third, I think, is we do need to be quite considerate. I think this came up in the text messages as well. We need to be quite considerate about emerging forms of credit and the opportunities and also the risks that they provide. So if we think of buy now, pay later, that could be a very helpful expedient to buy the school uniforms. It could also be a challenge if consumers using it don't realise that they are effectively borrowing and at some point that money does need to be repaid. And it's more the layering of different buy now, pay later contracts than rather one in isolation. Also, I think on the supply side, Theo, you and I worked very effectively, I think, on the Business Growth Fund, which was a superb model for funding SMEs. If that could be almost downsized to provide funding into credit unions, that might be quite an interesting model to explore. And for those on the conference, effectively, it was 50 private sector, public sector money, providing grants into CDFIs at the time. I think that repayment rates and the local knowledge and the ability to manually underwrite, so a much less algorithm-led lending decision proved very effective in that space. So I'll pause there, but some thoughts, I think, Sian, that I think could be taken on across the industry.
Thank you, Eric. And Theo, what's your view? I mean, it's really hard for CDFIs, right, to kind of be known about and to connect. Tell us more.
Yeah, definitely. I think it's such a good question and something that we and our members are working on every day because, like you say, CDFIs are really under the radar despite the incredible impact that they're having every day for their customers. But I think, at a high level, there's sort of a couple things that I think can make a difference because having that connectivity, there is this ecosystem we're all working in, but it is a bit siloed now, and breaking down some of those barriers would create a more inclusive system for people who are locked out. So I think at a high level, that Martin mentioned the must-have regards earlier. I think that's a really key way that we look at the US, and they have the Community Reinvestment Act, which requires banks to serve the communities that they're taking deposits from. And a key way of how they do that is through CDFIs, either partnering with them or investing in them so that CDFIs with the local market knowledge can do the direct, and they have local market knowledge and trust, they do the direct lending. So I think the must-have regard can play a similar role in making financial inclusion a key outcome that everyone's designing for. And by doing that, they are linking up more closely with the lenders on the ground that are getting great outcomes and have a great track record of doing that, like CDFIs. I think at a very practical level of, what can everyone do today, what we know is that when we were operating pre-pandemic in person, being able to signpost was a lot easier because you could have someone in CDFIs had someone in the branch working from debt advice. They seconded someone from a bank to help people open bank accounts. So it was all very connected in person in the branch, whereas now everything is online and digital and nonverbal. So I think it's presenting different challenges, and that's where a lot of this, development of tech solutions and using open banking is really important. I think that's still under development, but I think part of what we can do today is encourage tech partners to partner with the community finance sector like CDFIs and credit unions, because we are designing we understand people's circumstances more, and we're designing products specifically for them. So I think that's one practical thing we can do. And then I think the final thing is that we just need buy-in. I think you need buy-in at a really high level from government, from local authorities, from housing associations, from banks, that these partnerships help customers become better off. Because without that buy-in, it's really hard to make it work at an organizational level.
Thanks, Theo. And through this whole conversation, we're hearing about the importance of getting digital right. Alan Turley has mentioned in the comments and raised a question around that MAPS's own strategy says that 11.5 million people don't have the basic digital skills. And I know, Sir Hector, that that thinking about getting the right scale of delivery to the right people at the right time is a massive challenge. Do you want to come back on any of those thoughts?
Maybe just pick up on one or two of the comments in the chat on the debt issue. Maybe in my COVID fog, I wasn't totally clear, because there seems to be some misunderstanding still. So maybe I'll have another go at it. So just to say, as I mentioned, we're fully aware that there are a large percentage of the population continue to be digitally challenged. As I said, 29% would say they have low digital skills, and 5% are digitally excluded altogether. So we are absolutely aware that in delivering our mandate to help vulnerable people and provide quality debt advice to everybody who needs and wants it, that we need to make sure that we have the right set of delivery channels, which includes ensuring the right level of delivery channels for dealing with that group in vulnerable circumstances. I mean, just be clear, of course, if you're digitally excluded, face-to-face isn't the only way of communicating with you. Most people can communicate over a telephone and so forth, but they definitely, many people definitely need to engage with a person on the end of a line or face-to-face. And we recognize that. And it's really important that people understand we completely recognize that, which is why in the announcement we made, we said we would maintain our regional funding at 30 million a year for the foreseeable future, while we work out what the best way is to change the delivery model in relation to vulnerable people. So any suggestion that we're trying to cut the amount of money available for delivering help to vulnerable people is just not the case. We are maintaining the 30 million funding, which is broadly the same level as we had pre-COVID. What we have done, which is the good news, is significantly increase the capacity of the overall system. And obviously that probably the most cost-effective way of increasing capacity is through building digital and telephone channels, which is why we're putting the extra money primarily into those channels. But that's to help extra people. We're not reducing the funding available for the vulnerable groups. We're maintaining it at around 30 million. The second point I just wanted to mention is a comment in there briefly about money guidance, which again possibly doesn't quite understand what the role of the money guidance strategy there is. One of our key thoughts, which sort of maybe also plays into the whole savings and CDFI and various other points that have been raised, is it's really important to try to get the money conversation, because we know shame is a big issue here for people, the money conversation into any touch point when money could be discussed. And that obviously the biggest example of that is the workplace. But other big examples of that are the NHS process and indeed job centres and the DWP network. But in order to get a money conversation into a touch point where there is a professional who's an expert in the non-money field engaged, you do need to give them some help and training and potentially have some champions in their organization that raises the profile of having that money conversation. So the purpose of the Money Guidance pilot, the Money Guiders pilot, is about how can we engage with, energize, and utilize all these other touch points, particularly in the NHS and potentially social care sector and local authority sector, and then to route them into professional debt advice. Debt advice is a regulated activity. So Money Guidance is to encourage people to reach out for debt advice. It is not an alternative to professional advice. So I think maybe there's some sort of slight misunderstanding in that sector. In some of the chat there. So that's just a few thoughts, Sian. I'm not sure if I entirely answered your question, but I thought it was worth picking up some of the chat there.
Thank you. No, that's really helpful. And I know that, being one of the organisation that runs a partnership around debt advice, then having that clarity has been really important to the sector. So, thank you for taking the time to do that. And I know that more guidance is coming out from MAPS and in fact came out yesterday. We are going to run over a little bit because we're so lucky to have the people on the call that we have. And so obviously, if you individually need to sign off at 11, please do. But if you can stay for another few minutes while we put a couple of more questions to our panel, I'd be really grateful. So my final question to you as panelists, and I'm going to kind of fudge it, right? Because I've got Martin Kopak on the call, and Martin is important. And if I don't do this, then I'll get told off later in a very lovely Martin way. Thinking about the future, and many of us on this call have been working in this sector for, decades, and some more than others, but we've all been putting a lot of time and energy into trying to tackle financial exclusion. And in 2022, the fact that we still need financial inclusion ministers, the fact that we still have a financial inclusion commission, it's not just about the pandemic, is it? We went into the pandemic with high levels of exclusion, much higher than we should have had. So thinking about how we really make change and really increase the levels of inclusion, and thinking particularly about this dynamic around the catch-22 that Martin has described so well, which is that if the legislators, if social policy doesn't set out the guidance and the roadmap and the vision for what financial inclusion looks like, how do the rest of us get there? If the key conduct regulator around financial services doesn't have a mandate to make sure that firms are behaving in an inclusive way, then are they not having their hands tied behind their back unnecessarily? How does, for example, Eric at UK Finance really make sure that members are driving financial inclusion if you don't have the regulator behind you? How do we create a really kind of connected network so that referrals work well? These are really, really important questions. So my question to you is, what is the single biggest difference that your organisation could make to increase financial inclusion? And what needs to happen externally of your organisation for that to be true? So, Eric, I'm going to come to you first. What's the biggest difference that UK Finance and its members could make to increase financial inclusion? And whose help do you need to make that happen?
That, I think, in itself is the biggest question, isn't it? I could take this one of two ways. I think there needs to be sustainable funding, right? And that's not been solved over 20 years since we've been involved in and around financial inclusion. But I think comes back to the access point. The biggest thing we could do is have a collective understanding of what we mean by access. From there, we can then think about different strands of digital inclusion, other types of inclusion, etc. But for me, it's that gateway that we really need to focus on.
And can I come back to you, Eric, and just ask you one more follow-up question, which is, you've said really clearly that you think that the statutory duty is hard for firms. What do you need to make it work?
Um, well, it's interesting in the comments that one of the credit unions has mentioned that at their size, it's very challenging to implement a consumer duty. And I think one of the things that we're working very closely with the FCA on is getting some certainty and clarity in what it means. Now, I say that with a little bit of a caveat, which is actually in financial services, we should have the gumption to understand what it means. Equally, however, we need to make sure that the intent from the regulators is implemented effectively. So I guess a bit of a fudged answer, but I don't know at this stage I can give you clarity other than getting into dull specifics like there are rules in MCOBs and CONC and the Consumer Credit Act that simply do not work relative to the draft, the duty as currently drafted. But that's not for this conversation.
So maybe we can have a follow-up.
Yeah.
Fantastic, thank you. Theo, let me come to you. What's the biggest difference that your organisation and members can make, and whose help do you need to make that happen?
Yeah, thank you, Sean. Great question. So I think the biggest difference we can make and CDFIs can make is to build financial resilience and to save customers that poverty premium that they're currently paying for credit. So CDFIs, we could go from supporting around 30,000 customers per year to 100,000 to 200,000, and with that scale, driving the cost of credit down a lot. Right now, we know we're saving our customers £250 per £500 loan. That's a huge amount that could increase if we could scale. What needs to happen, I think Eric touched on it in terms of the funding challenge hasn't been cracked yet. So just to give you an example, to compare the scale, in the US, they just announced a $12 billion package for CDFIs as part of the US's COVID stimulus package. So that's $12 billion going into CDFIs. Even if you prorate that for the UK population and economy, it doesn't compare to what measures we have in place here. So, I think we need to be investing disproportionately more into interventions that work in financial inclusion. And what we know is that when there is that government support and concessionary capital, that crowds in private investment. So Eric talked about the Regional Growth Fund, which has been hugely successful. And again, in the US, we see that banks are investing, Netflix, PayPal, Google, all these corporates are investing into CDFIs because they reach communities that have been impacted by the pandemic. So I think that we look at that as a solution and a pathway that has worked, and we've seen it work here on a smaller scale. So that is what we think would make a huge difference and would enable CDFIs to help customers save a lot more.
Yeah, thank you. That's really helpful. I mean, we all know the mantra, don't we? We value what we measure. And there are very, very few nationally produced statistics around financial exclusion. There certainly aren't really any that come from the state. There's a lot done by good researchers, and the work that Fair by Design and Bristol University are doing around creating a poverty premium map of the UK will help us enormously in thinking about how we work at the micro level. The CRA in the States was a driving force in making it clear where firms weren't investing in local communities. I'm on the Action to Cash action group, and one of the things that I think is a real driver and a real kind of sea change about to come is the fact that we're going to have organisations thinking about what are they doing at their local community level. So there's a lot there. I'm going to come back to Hector for the final kind of piece here on, and I do want to ask the same question, although, so Hector, you might have a different kind of thought you want to share, which is around what's the biggest difference that your organisation can make and whose help do you need to make it happen?
Well, it sort of really was building on what you've just said, the earlier conversation right at the very beginning about data and reflecting on your question. So if I was asked the question, I could undoubtedly pick out a number of significant, I would say, sort of structural changes that still need to take place in the overall financial services ecosystem. We've touched on the need for more regulatory change. I think you could argue there's more to be done with corporate purpose and corporate culture. There's clearly more to be done with the development of products, but I suspect those development of products will only come about through further structural shifts in the nature of the financial ecosystem, which takes us to building up CDFIs and so on. I think, as has been mentioned earlier, there's a lot more could be done there. So I think the big question then is, well, most of us can recognize the need for these structural shifts, but how would we drive those structural shifts? We've all been, a lot of people here have been talking about them for some time. I've been talking about elements of them since 2004, and we're still talking about them now. So I think the answer probably lies with what you've just been talking about at the end there, Sean, which is data. So if we really did have a much better understanding of what is going on, both with people actually in distress and in need, and the industry, and what works and what doesn't work, and that information was held in a respected place that really could drive the debate. If we had a place which was generating thought leadership and influencing all these organizations and that need to make structural change, which probably includes government policy, by the way. So I suppose if I had a bigger budget at MAPS, which I'm probably not going to get, may I say, because we're putting a lot into debt, as we've just said, which is obviously needed. But personally, I think I'd be building the ability to try and create that thought leadership and that sort of clearing house of data. I'm not saying we need to collect it from everybody, but I'm saying that sort of bringing the convening power of data and really trying to drive the change in the collective thinking about the importance of financial inclusion. We need to think about how do we drive it up the agenda, because my view on life is that if something's really important to the nation, we'll all make mistakes. We'll probably come up with the wrong initiatives. But if it's right at the top of the level of public debate, eventually it gets sorted. But if you're not at the top of public debate, you don't have the impetus to make structural change. And the only way I think to get to the top of public debate is to have irrefutable data and information that proves our case. And I think we need to do more to try and get that. And maybe MAPS can play a role in that. In the perfect world, it certainly would.
Brilliant. Thank you so much. And it just makes me and others I know think, well, that's statutory duty and must have regard to for the FCA, because then they could also get data, couldn't they, from firms around it. So that's a really important point. I've just spotted Martin said the same thing in the chat. So I have really extended this time because what a brilliant conversation. We don't get these opportunities very often to have that level of thought and contribution and insight and engagement. So thank you. Thank you to our panelists for kind of being very generous and staying for longer. And then you've seen in the chat, Heidi's been brilliantly plugging all the things that I'm supposed to be saying, which are, this is just the beginning. We've long wanted to run a conference, and we don't have much resource at the Financial Inclusion Commission. You might think we do, but we don't have that much. So we've been choosing our moments carefully, and there are going to be follow-on sessions, deep dives into other topics. If you're interested, if you'd like to take part, if you'd like to speak, as we put out the calls and the agenda, then get in touch, and then please do sign up. All of the content from today will be shared afterwards, and also so Hector and others are very, very happy to continue answering questions. So if there's anything that you want to follow up with, please get in touch. We'll pass on emails, we'll pass on all the content from today, and we'll share Hector's speech. We'll also share John Glenn's speech, and as you know, we're recording. So thank you for everyone participating. Please keep your thinking coming, please stay engaged, and please join us for the next one. And a huge thank you to Heidi and Molly, who you can't see at the moment, for making today happen, because it's been brilliant work behind the scenes. Go and have a lovely day, and please keep fighting for good financial inclusion for everyone. Thank you.